Good afternoon, everyone. Thank you for joining us today. We're going to do some trading. Unfortunately, I will not be doing live trading today because I have some small issues with the related trading or whatever, but I will walk you through the process to discuss specifically with regards to the euro and with regards to the US dollar. If you recall, and you would see that if you go to the blog on which I have on FX Street, which I will be starting to update again as of today. Back 3-4 weeks ago, we were looking at the euro dollar. Anyway, before I go back to the euro dollar, let's do this because the time is sensitive now. Now, let's say we're going to trade the New York session. We're going into the New York session. We expect today, because Ben Bernanke is going to speak, that there might be some slowness, if you will, in the session because everybody's expecting some sort of announcement, even though nothing much is going to come out of it because the market now is at historical levels. I mean, if you look at the dollar yen, it is trading today, the dollar yen back in 1993, and exactly the low anyway. So looking right now, if you look at the dollar trading at 81.12 right here, this is exactly the low of 1995. And this was, again, this is the highest level, not in 15 years as they say, but this is the highest level ever that the yen has been versus the US dollar. And if you look at the monthly chart, I mean, you can actually see this is it. I mean, there is, even before I have data for like 25, 30 years, this is the lowest the dollar has been ever versus the Japanese yen, or vice versa. And based on the chart that you see in front of you, this technically would indicate that we are yet have much longer way to go to the downside. There is a lot, I mean, we can expect that the dollar to go much further to the downside, if you will. I mean, this thing, that kind of trend that you can see on the chart, this move coming like this and turning with giving us this big arc, if you will, can only indicate that we're going to see a much more stronger move to the downside. And the bias would be for us to maintain our short positions on the dollar yen. Now, at this time, I mean, as you can see back in 93, 95, 96, this was the real time of intervention. I mean, you can see now the Bank of Japan, the interventions over here. And when you look at a chart like this, yes, intervention can be seen on the charts or can be interpreted by looking at those big explosive moves. A big explosive move to the upside followed by an explosive move to the downside and then a breakout. So this is the time when the Bank of Japan came in back in 95, 96. The only situation is that the current or the present time is much different than what it was in 1995, 96. In 95, 96, the U.S. economy was not particularly in a good condition, but also the Japanese economy. They had this big boom in the real estate. They had the crash that came in after that followed. And they have been in recession, if you will, or technically in a recession since 1997. But it was in the best interest of the United States and the Japanese government and mostly all of the other European governments to intervene to bring down the value of the Japanese yen and to raise the value of their currencies. So the intervention that took place in this move that you can see, I mean, if you can see that this was April 95, and which was the yen was trading at 81, and by September it was trading at 103. So you had about a 20 or 25% appreciation. I mean, the yen depreciated by 25% and the US dollar appreciated by 25%. Now, in terms of a foreign currency, this is very big move in the terms of 4 months that your currency would appreciate or depreciate, depending on which part of the world you are, by 25%. This is quite a very big move. And as you can see here from the chart, all these moves, those big ranges, if you will, or those big price bars, are an indication of intervention. That means there was no even attempt of somebody to resume being short the US dollar, and everybody now, all the shorts got scared out, and now they are reversing their position and they're joining into on the side of the Bank of Japan and on the side of the Federal Reserve Bank of New York, and so on and so forth. But today, in the current market condition, which we are sitting right at it, exactly, I mean, you are within a pip or two from the all-time low. The Federal Reserve Bank of the United States, absolutely, it's a key reference point. But, and I mean, below that, again, you're looking for a continuation to the downside, and that's what it's doing. It's sitting at the reference point. So, with that, the current condition is the Japanese government wants to lower the rate of the yen, and at the same time, the United States are not particularly I mean, believe it or not, the United States are comfortable with this level at which the US dollar is trading. Why? Because it does two things. It serves two things. Number one, it raises the cost of imports. So this way the imports are going to be less coming in, and that would limit the cash outflow, because it is much more expensive now to buy a Toyota. It's much more expensive to buy a Sony camera. It's much more expensive to buy a Sony TV. Why? Because the Japanese yen is more expensive. If you look from here, from the beginning of 2010, let's say the dollar was trading at 95 yen. Now it is trading at 81. You got a 20% decline. I'll come to it so the US dollar declined by about 20%. This means that simply, I mean, if we just, I mean, there is more to the equation than this, but if we just use this equation of a 20%, this means that the Japanese imports, the Toyota will increase 20%. We will do them all, guys. Just hold on a sec. Increase 20%. Everything that the world buys from the United States is now cheaper by 20%, because they can convert their currency and buy more dollars. They can buy 20% more dollars that they will pay for goods and services in the United States. So we can do a little bit of the Dow Jones for you if you want. Now, the same thing, if you can see now, and right now, if you look here at the intraday, we are now putting a new historical low. What you're watching right now, guys, is basically, no, actually we had the lower low this was a couple of days ago, but this is the 80.88, which was yesterday, was the all-time low, and you have nothing but a downward bias for the yen, and we should be looking at continuously looking to short the dollar versus the yen, because this thing is going to continue. That direction is going to continue. It's going to be volatile, and this volatility is a typical behavior because people are simply scared. Everybody, the Bank of Japan is jawboning the market by saying, oh, we're going to intervene, we are unhappy with this, we're unhappy with that, they think the Japanese yen is too high, but there is so much they can do because they are not getting any support from the Federal Reserve Bank, because the Federal Reserve Bank has no interest to invest good money in supporting the US dollar or supporting the yen. They have enough situations they need to do to use the money in rather than supporting the yen. And the same thing with the European governments, the Eurozone. They are not interested in supporting the yen. They actually prefer that the yen would be higher so that, again, the cost of imports would be higher and they can export a little bit cheaper. And the same thing also with the UK government. So having those, that is the primary difference between what's happening today in the market and what was happening in 95. And you can see now the selling that's coming in. So yes, once it breaks down, that's it. You will take the trade and you have to continue with it. So if we're looking here just to see what's beginning to move. So basically the euro pairs, the euro Swiss, the euro dollar. So we're going to go into the autopilot. That's the euro dollar. You see the break in the euro dollar and the euro Swiss and the euro yen. So the euro is basically moving. So initially, if I'm looking at all of these, I'm looking to be long the euro. The dollar yen is already down 6 pips on the, and the dollar Swiss is at the low of the day. So I have the dollar yen and the dollar Swiss to be looking at shorting. The pound dollar is also moving to the upside. So based on looking at my radar screen, I want to be long the pound dollar. I want to be short the dollar Swiss. Nobody's pressing the yen, but it's already below 81. It's trading now at 94. At 80.94. It's 5 pips from the all-time low. Look at this. You see, Abel? Now, as soon as it breaks, you take the trade, and that's it. You have to stay with the trade. The idea is you have to be consistent in your trade because you really don't know which one is going to be the one that pays you or not, but this is a topic for another. So initially, we want to be short the dollar yen. Let's see the pound dollar. I mean, this is, you can see the chart that's breaking to the upside. I mean, this is everything that relates to the US dollar is nothing more than a profound bear market now that the dollar is in. It's entrenched and it is moving. Now, if you recall from a couple of weeks ago, actually 4 weeks ago, at the end of September, I posted on the blog a question for you guys, and some of you And that's what I would like to be doing in the blog with you, is that for you, I want to share this, have this stimulate our intellectual discussions, that basically, we, at 131, I'm sorry, when it was going to trade above the 129.91, that was the indication that we did have a trend change to the upside in the euro. And I posted in the blog for you that we do now have a trend change in the euro to the upside, and now the trend to the upside in the euro is going up. Some of you, we entered into this discussion, but that's it. That's the beauty when you have your price behavior signals and they're so clear, and now you have a trend. Now the euro is in a bull market, if you will, and you want to be staying with it. So, yeah, we're going to talk, Bill is talking, when would I get out of the euro dollar if you just bought it? Well, what is your trade? I mean, are you taking this trade on a long term, or you're taking the trade on a short term, on a day trade? Because these are two different questions. Your perspective for the trade will define the. Now that's the second trend change, Ava. No, it doesn't work this way. Never take, that's a rule, guys. Never ever take a trade based on the short term and turn it in a long-term trade. It doesn't work. More times than not, it does not work. If you're taking a day trade or a short-term trade, you take it as a day trade and a short-term trade. These are the rules that you got in, and these are the rules to get you out. But don't take a short-term trade and turn it into a long-term trade, even though you'll be having a profit on that trade. More times than not, it's going to turn around, and because the reason that got into the trade is different. What if it is in the direction? Well, again, if it is in the direction of the major trend, that's good, because that's what you should be doing initially in a short-term crystal, is that you always want to be taking the trade in the short term in a direction of the long term. But if you take that trade based upon short term, then there are many other factors that will. The idea is, when you take a trade, you want to stay with it to maximize your profits. Okay, you want to stay with it so that you can. No, there is nobody who's an expert, Jay Sherry. We're all traders, and it's just somebody has more experience. So the market every day teaches us lessons, and there is no right or wrong. All what I'm doing is I'm sharing with you some of my experiences, and sometimes I'm right, and sometimes the market is, nobody is right 100% of the time. All what I'm telling you is that I'm giving you something that gives you a statistical edge, that most of the time, when you take a day trade, and based on what you see on the chart on the day trade, then that's what got you in. Then you need to get out for the same reason. If your entry is initially with a long-term view, and you looked at the intraday chart and you took the trade based on that, then fine, you're taking the trade on a long-term view. But when you take a trade on the short term, your stops is different, your risk parameter is different. So for example, if you're taking a day trade, Jay, then your stop, for example, you're looking at 20, 30 pips or whatever, 40 pips, depending on the volatility. But if you're taking a day trade, then you're looking for 100 or 150 pip stop, or you're looking at putting your stop somewhere on a technical location. So that is the differences, because your risk parameter or your size of the stop and all that stuff differs, and then you'll be getting, so maybe if you, so it is safer than to make your decision on whatever the time frame or whatever the intent of the trade originally is. Okay? So anyway, as far as to go out from this trade, I'll be looking to get out of it around the structure point of 142.16. That is the next, it's not resistance, that is a structure point, a point of reference on the chart, and that will be the point. So it should be somewhere between the 142.16 and the 143.37. Most of you guys remember when we were doing the FX Street lecture in the beginning, and I think Abel, you were there, we went short at the 143.30, right there, the 143.33.7. That was the short, and that was the beginning when we took the bear market to the downside in the euro. Now we are in the reverse, so I have to go back to the point that we took to initiate the short in the euro. Most of you were with us at the time, and the 143.33 was the turning point of the structure failure, if you will, if you recall, and that was the primary trade. And let me show you the trade. I'll show you the trade in a second because I'm just changing the colors. I'm just changing the colors so that you can see it better. These are the trades in the euro. So remember I told you we go short at the 143. That was the first short at 142.16. And we closed the short at 137. So we had about a 550 pips on that trade. We took another short over here at 134.40, which did not work, ended up in a loser. We lost about 100 pips on that trade. So we're still up 400. Then we had the second trade when it broke the other structural point. If you remember the 133, somebody of you was talking about the 133 a minute ago. Right there, when it broke the 33, I did exactly what I am sharing with you. We took the short, and this blue line indicates a winning trade. We took the short at 132.66, a little bit below the break, and we closed the trade at 123. So we had about 1100 pips on that trade. And then right now, the market has turned to the upside, and this is when I told you that was the first break to the upside. We started buying the euro at 130, and we closed that trade on the day that we had the spike down, so that was about 50 pip loser. Then we are long, we took it long again from 129.21, and we are still long. We did not close the trade. So, I mean, that's live. I mean, I'm showing you this is live. And so you want to be staying with that trade. I don't have a reason to get out of it now until it gets me back to my original entry. That is my original entry on the short side. That is now, it's exactly like the 81.12 in the yen. It has to go back there. Most of the time it does go back there, and this is where is going to be the litmus test for me to decide, okay, now we're going to close it or we're going to stay with the trade. And this is the euro dollar. Let me change that so that you can see the size. We don't have 500 contracts on this one. So we are up. I'll remove the gold. So we're up on one contract. We went in at 129. So we're up about 1,200 pips. Yes, Abel, what do you want about gold? I'll finish this. So, and then I'll go and do the gold for you. So, what's your question about gold? As far as scaling in to the position, Toby, yes, we pyramid on the way in, but we have rules of pyramiding. There are rules to pyramid in the position. These rules are based, about a maximum position size. We do have what's called the maximum position size, and that relates to the capital that's being traded. This is the same financial rules that we use institutionally or being used by the institutions, is that you have to have a specific amount of unit. Let's say if you're trading gold, then there is a maximum size of gold that you can take, a maximum number of contract or ounces of gold that you take in relationship to your account size. Also against the profitability that you already have, how much percentage profits you have made on your original position. And then always the second position that you take is smaller than the first. That's why they call it pyramiding. So if you're going to start your first by 10 contracts, the second position up would be around 7 contracts. And then you're going to shrink it much more. So instead of 7, now you're going to slice it by half. You're going to be like 3. And then finally 1. You do not pyramid more than, fine. So what's wrong with that? And this is the pyramid. If it is, the lecture that I'm going to do in the ITC in Barcelona next week is specifically with the when prices are hitting new highs and you don't have reference points. So I know a few of you guys are coming, and several guys are coming from the UK. I will be actually showing you the software, giving you the software to try to trade with it while I'm training you there. So all the ones that are going to be coming to Barcelona, I'm going to give them TradeStation and our software. Well, the idea is have to be training you to use it, because if I'm not there to train you to use it, it will not do you any good. Okay, so well, unfortunately, these are the ones that were able to go. So anyway, beside the point. If it is going higher and you don't have a reference point, then I don't think it is an issue that should bother you too much. You should stay with the trade, because there is nothing wrong with if you have a bull market, then you want to hang tight with that bull market. It's once in a lifetime when you catch a real good bull market like that's what we're having in the, this is our long-term positions, if you will. Let me see the gold. Fortunately, the gold is not, let's put GLD, I guess we can see GLD. Yeah, I'm using a different account. Oh, absolutely. Look at this. Absolutely. It's an absolute, there's no question about that. And once you catch a bull market, look at this, we're long the gold from here, from 1,188. That's the entry for the gold right there. We are in a fantastic time today as far as gold, as far as silver, as far as platinum, corn, crude oil. All these now are moving very nicely, and it's a combination between the weakness in the dollar and people are again behaving in a specific way. If now everybody is buying the gold, you have no reason to expect them to change their minds in 24 hours and to go down. So in this case, it's you might get a little bit of volatility, a spike down like this, but that's all what it is. That's what it's going to be, a spike, but it's not going to be a trend change. This mindset from the low of the 07, look at this move. Let me turn off the trades. So Abel was asking me if this is a bull market. What do you see here? That's it. From 50, it started here at 50. It is now trading, let's say 132. So you have something that has increased in value about 200% in the spell of 4 years. If that's not a bull market. Somebody wants to talk about the Aussie dollar. The Aussie now is pretty much, the problem of the question, Abel, that's a very good question about a pullback, and this is why, if you are, remember when I showed you the entries in gold, and I showed you the entries in the Aussie, and I showed you the entries in the euro, everything that we do here is based on price behavior. As you can see on the screen, I have no indicators, I have no moving average, I have nothing. We only have the structure of the chart, the significant points, the reference points, and we take the trade. And using this kind of techniques, what it does, it gives you the entry at the best possible time. And therefore, you're not missing all this move that took place, and you're not sitting waiting for a pullback or hoping for a pullback. And that is why when we're using, for example, this is the Aussie dollar. Look at the Aussie dollar here. We're long the Aussie dollar from 91.80. It is now trading at 99.57. And keep in mind, guys, all what I'm doing is I am typing the name of the instrument. I am not making any formatting. I'm not we're just taking the trade based on the rules. And you see your entry at 91, you're already up 1,000 pips. So to answer Jay, we are long in the Aussie, and if we're gonna go, look at this, all these are long trades in the Aussie. We had a little bit of noise over here, but again, we're finally long the Aussie from. So if I'm going to remove the trades, what you see here, Jay, is this is an all-time high. It's a breakout to the upside. There is no reason for you to get out of the Aussie. You want to stay with it. Also because fundamentally the Aussie is closely related to the gold, and it is also closely related to wheat and the grains. Australia is one of the breadbaskets of the world, so there is a lot of demand now for for wheat and gold and copper, and so Australia is quite rich in that, and therefore, because of the dollar decline, these commodities increase in value, and that's why everybody, if you want to buy Australian wheat, you have to pay the Australian exporter in Australian dollars. So you have to buy the Australian dollar, and you sell in exchange for that. Ramallah, no, we're not. There is no immediate plans for me to come to the States to train in the United States, because we're starting a big project now in London here, which I'm very, very, very excited about. We're starting, I don't know if you guys remember, something in the 80s was called the Turtle Traders. And there was a very big trader in Chicago. His name is Richard Dennis. And he took 20 traders. He trained them, and he funded their accounts. And basically he started, and these traders ended up as some of the biggest hedge fund managers in the world. What we're doing is we're starting now, and here me and training traders, we are repeating the same experiment. We are going to take, yes, absolutely, we are going to take 10 traders. They will not, it's completely free. Yes, because you're going to be working with me. 10 traders, they're completely free. These guys are not going to pay a dime. On the contrary, we're going to give them like a small pocket money every week. They're going to come here in our offices. They're going to sit down, and they're going to be trained and working with me every single day. It's an apprentice. They are going to be trained to become on everything, long-term, short-term, blah, 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 getting the computer. I mean, we'll give them, and then send an email, CV, and just go. And after they are ready to go, they will be funded. Absolutely. The idea is we're going to take people from across the board. It doesn't matter. I mean, the process, the commitment is 2 years. You're going to come here because we're going to make a lot of investment in you in time and in money, because we are going to give you a real money account. I mean, each account will have $1 million in, yes, please do. Just go to the website and send a resume. Notional account, so it's going to be funded, and those 10 guys we will interview, and we'll see. And then after that, after we're done, while they're beginning to trade, whatever losses they have, we are going to assume these losses. And after that, they are going to start trading, and they are going to take a percentage of the profits. So whatever profits they generate, and they're trading under our supervision, under me and Ben's supervision, and that's the whole idea, and they will be getting paid. So we are repeating the turtle experiment. I mean, because I honestly do believe that price behavior now is the way to go. This is trading for the 21st century. All that stuff now, 100%. I mean, you'll be in the office. You are going to be an apprentice. It's not, I don't know, Abel. I mean, I'm not a real estate agent. It's a true apprenticeship. The idea of an apprenticeship is that we're not using when I use the turtle experiment, I mean the social aspect of it, or the primary belief that Richard Dennis had was he believed that trading is a teachable skill. Trading is something that you can train people to do if they know what to look for, if they can identify the right side of the market and stay with it. I am also absolutely, it was one of the biggest successes in the world. And I believe, and keep in mind, it is not an easy experiment, because after Richard Dennis, nobody repeated the experiment. Nobody put, even the turtles that have graduated as turtles did not actually put money to train the new turtles or a new group of traders. They went on their way to become some of the most successful traders in the world. I believe, exactly like Richard Dennis, that our methods and techniques and using price behavior is a teachable skill, is a way that will pay and make successful traders in the 21st century. And we are going to, but we're not using the turtle methods. I mean, we're not emulating Richard Dennis. I want to be clear on that. We're using our techniques, because the stuff that he used, which is brilliant, has been used in I don't want the people from the turtles say that Mike is taking, no, we're not taking the turtles, we're taking the experiment, the social, and the principle behind it is that, of course, it's a brilliant account. I mean, and I wouldn't even dream to be in the shoes of Richard Dennis. I mean, he's one of the gods of the market. So it's just, but I am a believer like him that, okay, hold second, hold on, that trading is a teachable skill, and we are trading traders is putting its money, and I'm putting my experience behind that. We're putting our money where our mouth is, because those 10 guys are not going to pay a dime. And we are going to be responsible. We're going to cover all the losses, and we're going to take a share of the profits, and we're going to create, hopefully, 10 successful traders. Anybody, unfortunately, I don't know about, it's, for the time being, Ramallah, it's mostly again, because it's 24 hours, we'll be trading together, we'll be sitting in a trading environment. I mean, we have now in London about a 10,000 square foot trading floor, and each trader will be sitting all the traders will be in a specific room, having teamed up. They will team them up. And Jenny, go to the website. There is the trainer's apprentice. Send your CV. Of course, I'll give everybody a chance. I mean, there is no, everybody has, that's the whole idea. That's why I'm announcing it. I mean, why am I saying it here? I'm saying it so everybody is welcome to join. And again, it's not a sales pitch. Nobody's going to pay a dime. This is not a sales pitch. Okay? I'm not giving you a sales pitch. Nobody's going to pay a dime. This is not, we are going to give people something. So I don't know, Boyke, you find a way. I forgot my real estate license, guys. Anyway, so that's the idea that we're doing with the the third of the apprenticeship. We have nothing to do with SpyGlass. SpyGlass is a different company completely. They have different shareholders. So there is no, these are two different companies, guys. I work with both, but now because of the apprenticeship, I'll probably be moving more towards training traders. What do you mean under the desk? Oh yes, of course. I mean, hey, I used to sleep under the desk. I kid you not. When I started in the early 90s, I used to sleep under the desk. Exactly. Do you think I'm kidding, Boyki? I used to sleep under the desk. I was given the graveyard shift, and we were trading the arbitrage, the spread between New York and London, the mercantile exchange. It's true. I mean, you have to pay your dues. And I used to wake up when at 2 o'clock in the morning, the phone rings at the price of gold, and we pick up the, no, if I had a mattress, they would fire me. It was a little bit like Seinfeld show, you know, this, putting the phone underneath the desk, and it was fun. It was, it's good memories, good memories. No, I mean, when I started, I mean, I was apprenticed. The reason we're doing this apprenticeship is that I was apprenticed, and if you see in my resume, I always say that I apprenticed under Alan Shaw. And that's why I appreciate the man, and I revere the man, and I revere what he did to me, and I'm appreciative. And, I mean, I was glad to go down. I mean, I'm not saying that we're going to do this to our apprentices, don't get me wrong. But at that time, he would say to me, Mike, go get my dry cleaning. I would go and get his dry cleaning from the dry cleaning, not and out of respect and appreciation. Okay? So anyway, yes, and that's exactly what, I mean, we're not going to go for the 2 million, but somewhere around that, yes. It's going to be a notional account of $1 million for each. So it's probably going to be the margin account about 100,000 per, something like that. The application will end in the end of October. So we're getting a lot of resumes. And keep in mind, guys, the selection process is not really scientific. Yeah, sure. What do you want to see? Yeah, but as soon as we're done beginning, yes. Yeah, come on. How are you? No, I'm not Velaz of anybody. Velaz, you pay to become an apprentice. Okay? We are not going to get a dime from anybody. Okay? This is not a sales... No, please. I mean, no, Velaz has his... We're not taking a dime. This is not a sales pitch. It's an opportunity for the ones that wants to join. What do you want to see, Akama? Online Trading Academy? You can't seem to pin me down. Okay, why do you want to pin me down? Who's that? Who's Rima? Is that you? You came in late. Anyway, it's oh, okay. Well, soon enough. I mean, you can do it online, Ramallah. I mean, you can do, we do a lot. We have a lot of people from the States take the course online, and I teach them. I mean, it's exactly as if you're in the classroom. What do you want to see in the Sunday session? Kamal, what do you want to see in the radar screen? You want the long point and the short point? Guys, anyway, today is Friday, Kamil. So we're going to do the Sunday session on Sunday. I am doing it this week. So you're all, it's at 7 o'clock London time. If anybody wants to come into the Sunday session, they can go in and register. So we're going to redo the whole, but today, I mean, if you just take a look at it, I mean, these are the long points. We're already long the Aussie from 97. This is the day trade and the Aussie CAD. Let's see the Euro Aussie because Mary trades the Euro Aussie. So let's see what it's doing. I want to take a look at it. It looks okay. I mean, it's being sideways since yesterday. Okay, Vince, I mean, I definitely, I want to, absolutely, Vince, but I want you to, understand one thing. The selection process, of course, I will add. I will look at it. I definitely take it. I want you to keep in mind, guys, that the selection process is not scientific. It is not, I mean, nobody knows. So there will be a selection from the, one paragraph because we cannot read more than one paragraph. And let me tell you, one of the things of an apprentice is he or she has to follow the rules. If I ask you to send one paragraph, it should be one paragraph. If you send more than one paragraph, then you've broken the rules. And that, again, coming to the office, the criteria, again, it's a widespread, we're trying to do a wide canvas, and it's just a mindset, trying to have, of course, absolutely. I mean, I would like to have as equal number. It is like an army. It is, remember when you're working as an apprentice, you are there to learn. Okay? Then if you're there to learn, then you have to follow the instructions. Okay? It's as simple as that. It's not an army. It's not military. If you're unable to learn, then there is no reason for you to be there. So it's not the dollar recovering. Yeah, it's bouncing back again. It's sitting at the 81.12. Yeah, exactly. I mean, it's just, I mean, if you see, this is what we call the fear. You see what the low of the day is? The low of the day is 81.81. It just, and they just run away. And everybody's scared. Okay, Steve, send in your resume, my friend. Send in your resume. Again, it's a mindset. We're going to do our best to be, again, we're trying to see the candidates that are, have the proper mindset, if you will. And we will, interview them. We'll invite them for an interview. We're going to have a sit down, and then again we will pick the 10 guys and or gals, and hopefully we will be successful. I mean, and we're going to be teaching them basic, primarily technical trading. Long term, short term, and then as I said, we're going to fund their accounts, and we'll take it from there. And hopefully, if the success, and God willing, the experiment will be successful. Next year, we're going to hopefully repeat it again, and we're going to continue to repeat the experiment. The idea is that I'm a firm believer that trading is something that can be taught. And in essence, guys, do not mingle SpyGlass with Training Trader. They're two separate entities completely. I wrote the courses for both. Okay? So, but if you want to do something, go now to Training Traders, because as I said, since we are starting the turtle experiment, most of my time now is going to be with Training Traders. Well, the idea of, that's good, Cornell, the idea of webinars is good, okay, and there is a lot of ideas and a lot of things that come out of it, but the problem that is that there you are exposed to multiple disciplines and multiple ways of use to look at things, and since you are on the receiving end, if you will, sometimes it gets confused. So what we do is technical trading, okay? It is actually it's practical. So, for example, let me give you an idea about what the difference between technical analysis, market analysis, Kevin, and technical trading. Can anybody tell me what trading is? What do you think trading is? It's not a test. I just want you to join in the conversation. The idea of math probability, okay, that's good. Buying and selling instruments based on sound analysis, proper, somebody made by somebody who made money, okay. Currency movement, managing risk, okay. All of that is good and well. But how can you buy low? Okay, that's enough, guys. That's enough, guys. That's good. How can you buy? Let me ask you a question. Can anybody predict the future? Can anybody predict what tomorrow? No, it's not a gambling game. It's not a gambling game. If nobody can predict the future, if nobody can say that tomorrow the dollar yen is going to go up, maybe if you listen now, you will see that it's not about losing money. There is a way to make money. Trading is a way of thinking. Exactly, Nikita. Probability. Trading is a way of thinking. How you think is what makes you as a trader. If you accept the fact that none of us, including me and everybody else in the world, cannot predict the future, or that the moving average is going to cross and this is going to go up, or I have a divergence, this is going to come down, or whatever that story is, okay? If I cannot predict the future, why should I even attempt? Not even precise equations, because you cannot take in all the variables, Steve. The number of variables that are in the market are so immense. And even though, Steve, that you can take all those variables in the equation, in the mathematical model, if you will, there is another variable that you cannot account for. I'm going to tell you that in a second. There is another variable that you cannot account for. And that variable is the other traders. And they are millions and millions and millions of traders, and each one of those is a unique variable. Each one of those, with the size of money that he brings to the table, with the size of position that he brings to the table, is another variable. And however strong a mathematician or a computer guy, you cannot take all these variables, all the other traders as variables in the equation. So there is always some missing variables. Okay? So with that, what we need to do, we are going to discuss probability. What is probability? Take a look at this chart. Okay? Can you see this chart? Let's take a look at those two yellow lines. See those two yellow lines? These yellow lines? These yellow lines. Okay? And I'm going to scroll back multiple days. I'm going wherever it just goes. Okay? Let's start from here. Again, I'm just using an arbitrary number. I want you to count. I want you to count. The rule is, if it gets above it, you're going to buy. Below it, you're going to sell. That's the simple rule. Okay? And I want you to count how many times it breaks below that, you make money, and how many times it goes above it, you make money. So, and I want you to count. So, that is 1. Every time 2 yellow lines, we're going to take the trade. 2 out of 2. I'm going to move faster so I get the other line. There's a third one, so we're going to see what's the outcome of the trade. We don't know the outcome, so we have to take the trade. That's the third one. This one did not work, so I have 2 winners and 1 loser. Okay. This is another mediocre, mid 50-50 trade, so we're going to call it a loser, so we're not going to waste. So I've got 2 out of 50-50 system now. Right here you have another one, so you have a winning trade and a big winning trade, and you can see that here your losses are small. So 3 out of 5. Here is another one. So 4 out of 6. Another winner. 5 out of 7. Okay, and if you keep on going like this, and you can see every time it breaks, you have a winner. So based on just counting this, if I have something now that, let's say, works 7 times out of 10, what does that mean? That means now it's a probability. Every time you identify this setup, whatever that setup is, you are going to have a positive expectation. Your odds are, the probabilities are, you're going exactly. Then the odds are you have a system, and now you have something that works 7 times and loses 3 times. Again, the ratio is the second step, SW1. I'll explain it to you. That's what we train people here in the training traders. First, we change your mindset on how to look at the market and how to look at system. That's why everybody that buys a system out there not knowing what it is would lose his money out. Exactly. So the first thing is you have to understand that now you have a system. You have now something that gives you the odds of success. So it's no longer gambling. It's no longer gambling, Ben, because you are taking only high probability trades. The second part of the equation, SW, is we are now going to identify our risk. How much am I risking on that trade? And when I begin to make money, how long should I stay with the trade so I can make the most money? Okay? So, with that, what we call the risk, and that would also be the money management aspect of the trade. So if you have something that works 7 times out of 10, I mean, it's a simple math. Let's do it here. If I have something that works 7 times, and each time I make $3, absolutely. Absolutely. That's why, and each time you make $3, then when you win on that day, you or that week or whatever, you made 21 bucks. And on the losing trade, the mediocre hands, exactly, JA, you throw away the mediocre hands, or you bet small, or you don't bluff too much. So, if in the losing hand, the 3 losing trades, you're going to lose $1. So, this means you're going to be down $3. At the end of the day, you're up, you're plus 18. That was what trading is all about. You don't take the losses personally, you don't take the profit, and you only take the high probability trades. And that's what sets you up to become a successful trader. It's a mindset. So some guys, I mean, if you take being an analyst, so again, this is what trading is all about. It's a way of thinking. It is not a way to analyze an indicator. Even if you have an indicator that works, fine. But you still have to be objective, and you have to approach that indicator with a mindset of trading. Okay? So, and if you do that, then you're going to can become a successful trader, because you can expect that there is a number of losses and a number of winning, and you want, when you're winning, you want to make the most of the trades. Okay? Well, SW, I could have lost, absolutely, you're 100% correct. Listen, SW, I want you to understand one thing. There are no 2 days that are alike in the market. Okay? Today is never like yesterday. I have been in this business for 32 years. Okay? I have never seen 2 days that are alike. They're completely different. But what the constant thing that hasn't changed is how people deal in it. So, exactly, each trade is unique, because they're not two are alike. So what we have to do is try to minimize the variables that are going to affect our decisions. And we also need to be flexible. So sometimes, I mean, I'll show you something. Look at this area over here. Look at this area, SW. If you look at this area over here, you can see that in this area, every time you took a trade out of the yellow zone or the purple zone, you didn't make any money. Every trade that you took out of there was a loser. There are different sessions, Master. I mean, I can explain them to you. I mean, we're running out of time, but there are different sessions that we trade. Okay? And we run the autopilot on the trades. So, for example, I want to show you. So anyway, I'll explain it in a second, but so the idea is, SW, if it is going against me, I know that once we counted them, that we are making 10 times winning trades, and we're losing 3 or even losing 4. So my job and your job now, if we know that we have this statistical edge, we can quantify that, because 6 times are winner and 4 times are losers. So what should we do that you and I, SW, can make money? Exactly, Master. We need to make sure that when we lose the least possible. Exactly. And when we win, we stay with our trades for the most possible time, so that we can maximize. So we have to do two things. One, minimize our losses as best as we can, and maximize our profits as best as we can. And we have, as I said, what we call the autopilot. So the autopilot, what it does, it gets you into the trade and it gets you out of the trade. And it gets you out in the best possible way. When I say the best possible way, I don't say that it knows that in a predictive matter or a predictive manner. Rather, it gets you out based on the best statistical exit. Because we have been able to identify, this is the only software in the world that is based on price behavior. There is no moving averages, there is no MACD, there is nothing. It's setups, charts, structure. And once I have a break from here, like this, then most probability I'm going to get so far. So the exit is the best statistical exit. And that is how you can measure a system successes or failures. Okay? Is, again, if you understand the statistical edge to get you into the trade, and you can understand the statistical edge that gets you out of the trade, then the odds are you are going to be a winner. It is not voodoo science. It is not E equal MC square. Yes, there is a record for it, and you can, again, I want to be, again, clear, SW. I am not a proponent of selling software. Okay? I do not, if somebody has not taken the rules of price behavior and does not understand the price behavior and the rules behind it, and he comes and says, I want to buy the software, I mean, I'm not going to say no, but I will actually talk him out of it. Because it is, I mean, what's the benefit in it for us and for you if you come, let's say it's a plane and you don't know how to fly and you come to me? I understand. No, I understand. I just want to explain that. Nothing to be sorry about. These are a legitimate question and I respect that. And I'm giving you an answer. I appreciate your question. No, on the contrary. Think of the software as a plane, and you come to me and you say, Mike, I want to take this plane for a test drive. And you do not know how to fly. And if I hand you the keys, I mean, I'm sure you and I both know the outcome of that if you take a plane and one doesn't know how to fly. So it is not going to be in your best interest, and it's not going to be in our best interest. I would rather very much, exactly, I would rather very much if you learn the rules behind it, and that's what we teach in the course, in the training, understand how it's done, how it works, where to buy, what is the rules to stay in the trade, how far to get out. Remember, we're talking momentum, we're going to be trading. Some people tell you that volatility is bad. The market is very volatile. I'm not going to trade. The market is volatile. What do you mean the market is volatile? That's what you want. You want a volatile market because you want something that moves from here to go up there. It is not the fault of the market that it's volatile. It is that person's fault that doesn't know how to trade it, because there is a specific way to trade this market on the way up, and there is a specific way to trade this market, which is moving sideways, and there is a way to trade the market when it's turning around. The market changes, the conditions of the market change, but a flat market or a sideways market is like a flat EKG. You don't want a flat EKG. That market is dead. You don't want to touch it. You want the market that's moving, but you need to know how to approach the market in its movement. And there is no voodoo to it. It's all common sense, and if you know what to look for, then you will have the answer. Okay, we have another 6 minutes, so SpyGlass is a different company. The training traders have been started here by a group of traders. We had the dream of, or the belief, the common share that trading is a teachable skill, and we discussed in depth about doing the turtle experiment and taking 10 traders in and training them and funding them and supporting them. So the group of guys that came in, what we're going to do was to train traders. That's the name, training traders. That's basically what we do. And we are going to do so it had to be a separate entity. And I don't know why a lot of people are asking this question, SpyGlass and trading. So, but it's, again, I am a common denominator. I'm the one that's doing the training in both. Okay? You're very welcome. You're very welcome, Akama. All right. We have about, I think, about 6 minutes. So I'm going to open it for a question. Anybody has any question? Because we should be wrapping up in about 6 or 7. And guys, just do me a favor, please. If you know of somebody that might be interested in joining the apprentice, please let him know. Send him an email, because again, it's a numbers game, and maybe we get lucky with one person. So maybe guys Kamal in the Middle East or whatever, if you know of somebody that would be interested in actually applying for the apprentice, I would appreciate if you let him know or her know. Discipline exercises that I use other than the screen time experience. As long as you can come into the here in the UK, then you're welcome. Thank you, Peter. Just go to the website. The stock market, Master, is going to be positive right now, and the reason behind that, yes, I will remember, Vince. The US dollar is now extremely inexpensive. Yeah, you sell the yen. It is good selling the yen. No, hold on. Selling the yen, no. Right now, it is good to sell the US dollar and buy the yen, but you need to time yourself, because Pat, the market now, no, we don't want cash in anybody's account. The 10 traders, let me clarify this, the 10 traders that we are going to take, they will have zero payment. They will pay zero. We will actually pay them a monthly salary. Okay? This is a monthly salary. The 10 traders that we are going to hire as turtles, they will have zero cash outlay. We are going to fund them, we're going to support them, and we're going to cover their losses. Okay? You're in the pound yen. You really want it easy, Abel, huh? You want to be buying the pound yen? Yeah, it wouldn't be bad, Pat. Okay, I mean, on FX Street rules, I cannot tell you buy or sell. This is against the rules of FX Street, but I will tell you what I would do. Okay? So out of respect to FX Street, and I thank them for giving me this forum, this, for me, I would be a buyer of the pound yen. Okay? But this whole area, as you can see, is a big congestion area. I will be taking it on the long side. And again, ADB, that there's nothing wrong with that. I mean, it's a point of view. It is bouncing So at least I have another one more day at a minimum to the upside. If you want to take it as, if you want to take it as, if you want to apply, Larry put the application, go to trainingtraders.com. There is the apprenticeship there, and you can just fill the resume. Yeah, exactly, Pat. You can buy there. So I'm gonna put the chart the intro there. But maybe what you want to look at, Pat, the pound yen. Let's see the pound yen. Where's the pound yen? The pound yen. It's trading at 130.60. Okay. Where's it? That's why I was confused. Personally, I would buy it. I would buy it, and I'll be placing my stop below the somewhere. Probably I'll be giving it like 40-50 pip stop. I mean, around the 130 stop. Okay, that's me. Okay, I'm not telling you what to do. That's me. Yes, guys. Again, there is nothing wrong with having. You see, this is okay. This is a very good example. I'll have 2 minutes to explain this. Hold on a second. Okay. Somebody was saying I would be selling the pound yen, and what we're doing now, when you say I would be selling the pound yen, we are using our gut. We can say, yes, I want to sell the pound yen because I think the pound is going to go down and all that kind of stuff. That is fine if you have developed the instinct with the instrument that you can understand and use. But if we have a rules that gives us the statistical edge like I have explained before, then it tells us which side of the market I should be. So like I said to you here, above these lines we are buyers. So since it's above these lines, I think it's Pat or I don't know who was saying, then my now selling is no longer an option. Because if I sell it now, I am breaking the rules. These rules are the ones that give me the statistical edge. These are the rules that have paid me at the end of the day. So as long as it is above those two lines, I have no reason to sell it. Not that I'm telling you that I'm expecting it to go to the moon, but I just follow the rules. Thank you, Ken. Okay, guys, I think we're coming close to the session. I want to thank you very much, and I'm depending on you guys. Put the word out. We want all the turtles to join us. Whoever has the aspiration to become a trader to join us. Okay, guys? Thank you very much. God bless you guys. Thank you all.